Hello listeners, my name is Natalia Amutana and welcome to our first program in our series, Let's Learn Accounting, which is produced for grade 9 JSC learners and anybody else who has an interest in the subject. Today we are going to learn about accounting concept. Please have a pen and a notebook ready so that you can make notes of the important points, and do not forget to take part in the quiz at the end of the program. At the end of this program, you should be able to 1. Identify and describe the different accounting concepts and terminologies, which includes assets, liabilities, owner's equity, and double entry principle.
Up to the sky, jump to the sky, up to the sky.
It's almost time. David, let's go to class. The accounting class is starting now. And today's topic is accounting concepts. My mom told me that the accounting concepts are the most important part of accounting.
Nah, I also went to go study about it. Yeah, let's go to class.
Good morning, class.
Good
morning,
miss. Please take your seats. Yesterday, if I'm not mistaken, I gave you homework and you were supposed to go and find out what accounting concepts are. Did you all do your research?
Yes,
miss. David, tell the class what you have found out.
Okay, miss. I learned that accounting concepts are the basic rules of accounting that should be followed in preparation of all accounting and financial statements. It refers to the basic assumptions, rules, and principles which work as the basis of recording of business transactions and preparations of accounts.
Thank you, David. Financial accounting, both practical and theory-based, is built on some accounting principles. There are some accounting equations that support these too. And these accounting principles are built on a few assumptions that we call accounting concepts. For every transaction, there are 3 things that are affected, and they are assets, liabilities, as well as owner's equity.
Miss, I know much about assets. Assets is anything of future use in operations of an enterprise and belonging to the enterprise. For example, land, buildings, machinery, and cash.
Oh, Miss Antana, I also know that there are 2 types of assets, namely the fixed asset and the current assets. Fixed assets are actually the assets that are purchased for long-term use and are not likely to be converted quickly into cash, such as land, buildings, and equipment. While current assets are those assets that are so expected to be converted into cash within a year, such as cash, stock, debtors. But what is meant by the term liabilities?
Oh yes, liability is the amount owed by the enterprise, which is also referred to as a business, to the outsider except the owner. For example, trade creditors, bank overdraft, loan, and so on.
But then, miss, what is the name given to the money interest the owner has in his business?
Thank you very much, David, for that important question. We call that owner's equity. As you said, it measures the money interest that the owner has in the business.
Now, is this owner's equity also an asset?
Technically, owner's equity is an asset of the business owner, not the business itself. Like what David said earlier on, business's assets are items of value owned by the company or by the business, or we can even say enterprise. Now, as we said, owner's equity must always be equals to capital plus net profit, or if there is a net loss, we subtract it, and then we also subtract drawings.
Miss, can I please define capital? Capital is the contribution made by the owner to the business in the form of money or any other sorts of assets.
Well, all businesses need money to start or to run smoothly. John, you can try to define drawings, please, for me.
Okay, let me try. I think drawings occur when the owner takes or withdraw money or goods from the business for personal use.
That's good. I'm so impressed. And on drawings, please pay attention to the keywords, which are for personal use. And I repeat, for personal use. On our owner's equity equation, there is a net profit. Now let me explain net profit. Net profit is a profit of a business after operational expenses and other charges like depreciation have been subtracted from the total revenue, which is now, to say in short, we calculate net profit as follows. Net profit is equals to income minus expenses. Income is money which the business receives on day-to-day basis, for example, selling of goods or providing a service. Examples for incomes are as follows: sales, commission received, and rent income, to mention a few. While expenses are any amount that is paid or incurred by the business in the day-to-day operation of the business, for example, telephone and water and electricity, to mention a few. Please note, if expenses are more than the income, then it is a loss. I repeat, please take note, if expenses are more than the income, it is a loss.
That's awesome. Thank you, Miss. Now I understand that when the owner uses personal fund to put into the business, it's called capital. While when the owner uses business funds for personal use, it's called drawings.
Nice, David. I also understand that if the business receives money from a day-to-day operations, it's called income. And when the business pays money for day-to-day operations, it's called an expense.
Well said, John and David. We can now move on to the last part of our discussion, which is the double entry system. The double entry system divides each page into two halves. The left-hand side of each page is called the debit side, while the right-hand side is called the credit side. The title of each account is written across the top of the account at the center. John, can you please explain or define for us what double entry system means?
Okay, let me give a definition of double entry system. The double entry system is an accounting system where every entry in an account requires a corresponding or opposite entry to a different account. Did I make it clear?
Fantastic, John. Job well done. In other words, every transaction affects both the debit side as well as the credit side. Please note that debit means the receiver while credit means the giver. For example, paid rent by cash for 5,000 Namibian dollars. Now in this case, cash is giving to rent account, which is now the 5,000 Namibian dollars, which means we credit cash account because it is a giver, and we debit rent because it is a receiver. John and David, can you please tell me, what have you learned today?
Okay, ma'am. Okay, so I'll start with liabilities. Liabilities is the amount owed by the enterprise to outsiders. Let's say, except the owners though. Let's say creditors, bank overdraft, and loan. While owner's equity is an asset of the owner and not of the business itself. And drawings occur when the owner withdraws or takes money or goods from the business for personal use.
I also learned that when the owner uses personal fund to put into the business, it's called capital. But when the owner uses business funds for personal use, it's called drawings. Also, if the business receives money from the day-to-day operation, it's called income. And when the business pays money out for a day-to-day operation, it's called expenses. Assets, drawings, and expenses increase on the debit side, while owner's equity, liabilities, and income increase on the credit side.
Interesting. Job well done to the two of you. That brings us to the end of today's session. But before we say goodbye, it's quiz time. The question for today is, which type of asset is land and building? Now you have to choose between the three answers. A, is it a fixed asset? B, is it a current asset? Or C, current liabilities? So until next time, goodbye.
Up to the sky, up to the sky, jump to the sky.
This program was brought to you by NAMCOL with funding from the Ministry of Education, Arts and Culture and the Commonwealth of Learning.